You know, you might be running out of time because while Janet Yellen and her buddies on the Federal Reserve did not hike interest rates today, I'm telling you, they sure hinted they will soon. Welcome, everybody. I'm Neil Cavuto, and Fox on top of interest rates poised to move up, and maybe sooner than you think. It is always risky to say, but former Federal Reserve boss Paul Volcker just told me this much is not. This party can't and won't go on forever. The Fed has propped this up. Do you worry about that?
Look, at some point, rates are going to have to go up. I think that's inevitable. Everybody said that. If we have a good operating economy, you don't operate an economy on zero interest rates.
But they are staying at or about that very low level for now. To some experts on what could be happening just a few short months from now, we've got Fox Business Network's Charlie Gasparino, who's been reading between the lines, Jonas Max Ferris, who sees no reason for rates to rise, at least now, and trader Alan Uckman over at the CME, the Chicago Mercantile Exchange, on what will happen to the markets once they do. All right, well, Charlie, the betting is, and we seem to have heard that well telegraphed on the part of the Fed chief that it will happen, and by the end of this year. You agree?
Well, you know, it's like death and taxes. It always happens, right? I mean, it's like when it's going to happen is the key thing. And I'll tell you, Neil, I thought she left herself room to postpone this thing. And I believe it when I see it. And when it happens, it's not going to be that dramatic. I know that. But I still believe it when I see it. I mean, this is an economy that, you know, we have a lot of mixed data. Like we have 1 month that's really good, one report that's really good, then the next report is pretty lousy. We have a negative GDP print, and then we have a decent employment report, and then who knows what's going to happen next. This is not a strong an economy that's strong with conviction.
No, well, but that might be right. But Jonas, one of the things that comes up in this discussion is what's the big deal if and when they do? It's been 7 years we've been getting used to this. It won't, in other words, be a willy-nilly hike aggressively in rates. It might be a quarter point when it happens, if it happens this fall, and it might not be a lot more after that. Would that be a big deal? What do you think?
No one really knows how everyone's going to behave. There's the investor sect. Are they going to panic and leave stocks that they were only in, say, stocks or real estate because rates were 0%? And then there's the consumer benefit. Are you going to borrow a car? Are you going to buy a home? If you start panicking, the rates are going to go higher. You can't afford the payment. So no one really knows how it's going to go down. The rate increase is likely going to be so low and so slow that it might be almost imperceptible to the consumer, maybe not the investor who's watching every quarter point move in futures of what the Fed funds is going to be. But I don't think, like, if you're going to buy a car, you have to, like, rush out and lock in this low interest rate loan. That's not going to change anytime soon.
Well, then, Alan, on that notion, you think it would be a mistake to even do a quarter point or anything like that now? That we're not ready for that? Is that what you're saying?
Well, I think that quarter point obviously is going to be symbolic. It's the most widely anticipated rate hike in history. But for me, I'm going to view it as a sign of strength. It's actually going to be a nice A report card because they're telling us the economy is strong enough to handle it. So it's not so much that first hike, but it's the pace of the hikes after that. That's what concerns the marketplace.
You know, Neil, they rarely, I mean, listen, Paul Volcker was a man of his word and a tough guy. He raised rates during an election year and basically got the president who appointed him, Jimmy Carter, booted from office because he created an economic slowdown by raising rates back in 79 and 80. You know, I don't
Charlie,
see.
we might point out that when he raised rates, he
that was a
raised
little
them like
different.
a point at a
But
time.
I don't see Janet Yellen having the fortitude to raise rates and to hurt the stock market. One of President Obama's signature economic achievements is in the stock market.
So she won't want to do that. But Jonas, do you think
I don't think she will.
All right, Jonas, do you think will it make much difference? I mean, the markets did their thing, food stocks did their thing, energy stocks did their thing. Oblivious or maybe despite this stuff. What do you make of that?
Well, she doesn't have to do those things because there's no reason to raise rates.
Yeah.
The economy can handle low rates now for decades. It's going on in Europe and in Japan. This fantasy that we have to return back to the 70s or 80s with 8-9% rates is crazy. The only
So what does
reason,
that mean? That
there
a
is
slight
one reason to raise
a slight
rates.
uptick in rates would be okay with Jonas Max Ferris. It wouldn't be damaging.
It wouldn't
even
be
though
damaging.
the IMF is saying, don't even do it. Don't even think of doing it.
It would be better not to do it. The reason they're going to do it is so psychologically people can be comfortable that we're not, you know, it's all this panic. They won't stop talking
No, there's
about
one reason to raise.
It's going to be like China. We're going to have a property bubble. It's
Jonas,
a fantasy.
There's one reason to raise rates, and it's pointed out by investors like Carl Icahn and others. There are pockets of bubbles in the bond market, and those things, that could be a problem. And here's where we get in a problem with the stock market. If they have to raise rates to deal with that bubble while the economy is still slow growing, that becomes a little treacherous. Now,
All right,
we don't,
well,
I don't
Alan,
know
on that
yet.
point, that is a worry, Alan, that all of a sudden it's not so much the economy, but the bubble that the Federal Reserve and others are concerned about, that bonds are unrealistically, the rates are unrealistically low. It's leading to crazy, risky behavior again, and the Federal Reserve is worried. Should it
Well,
be?
it's not just us. There's been a race to the bottom around the world, and our rates have had a healthy bounce. We're 0.5% higher on the long-term bonds that are not governed by the Fed action. Those are driven by supply and demand. So the markets out there, if you look at the 30-year and the 10-year note, are reflective of raising rates, and that's a reality. It's not a matter of if, it's just a matter of when. I don't think it's going to be a big deal for the market unless they do a series of back-to-back-to-back rate hikes.
Guys, I want to thank you all with all this breaking news. I certainly appreciate it.
Thank you.